Oh, Bismillahirrahmanirrahim. So we're continuing the last lecture. So basically the efficient market hypothesis says that if there is any stock whose price deviates from its fundamental value, which is the discounted stream of future earnings, then arbitrage will take place, and the arbitrage will drive the price to the fundamental value. Now actually, Myron and Scholes decided to implement this idea in practice. So they created this fund which is called a long-term capital management. And they found this new method to determine the value of derivatives. And so this new method they used to price stocks, and so when they found deviations of the market price from the price that the theory told them, then said, okay, this is a profit-making opportunity. And then they used this hedge procedure, which we have described briefly. It's very complex. Basically, what it involves is that you buy the same security and also sell it, the same security short in the future at the supposedly theoretical fundamental value. So basically, because you have bought and sold the same thing, then as long as the gap between the long-term price and the so-called mispriced security becomes smaller, which is what you expect on the basis of rational expectations, then you will make a profit. If the gap becomes larger, then you will make a loss. So initially they were highly successful, but eventually there was a complete collapse. And when they were asked about this collapse, they said that, well, a 6 sigma event happened. That is, according to their model, the probability of this event was 6 standard deviations away from zero. Now, in a normal distribution, the probability of a 6 sigma event is less than 1 in a million. So, according to their theories, this was virtually impossible. But in the real world, the model didn't apply. So they were making calculations which were based on assumptions, and those assumptions don't hold in the real world. So basically the theory which upon which the efficient market hypothesis is based has been tested and has failed in the market. So after long-term capital management was wound up and closed down, then a new firm was created in December 1999, and they saw that LTCM had been very successful for a few years, but it had a great collapse. So that, okay, there is something there. Let's try to replicate this strategy, but let's not take as much risk as before. So they used less leverage. In 2008, this firm also collapsed with a 44% loss, and it was also shut down. So again, so basically this strategy of hedging, and basically you can look at the details, but if you look at the big picture, you are betting that the gap between the if a stock is overpriced, meaning that its value is higher than the fundamental value, then you are betting that the gap will become narrower. Now, instead of any what is called a naked bet, in the sense that it is not, I mean, if you bet and you bet wrongly, you lose everything. They cover this bet by making a hedge bet, making a bet in the opposite direction, so that you get some protection against losses. You don't get fully protected, obviously, but you get some protection against some chance deviations. So this is about the best you can do in the real world, and the best you can do. So basically what the theory says is that people will do this and they will buy the overpriced stock. They will short the overpriced stock, so that will cause the value of the stock to come down. And if the stock is underpriced, they will buy it, and that will cause the price to go up. Now, this was actually done by these firms, and the strategy didn't work. So the theory was tried, and in practice it failed. That's clear. Now, there is a lot of discussion on these things, and I'm going to give you an assignment about figuring these out later. So he's explaining how these things work in terms of hedging. So this is one of the methods that if you think that a stock is undervalued, it's currently at $30 a share, and you think that it will go to $40. So what you can do is you can buy the stock. But that may be too expensive. So for example, here it would be $3,000 to buy 100 shares. So another way to do this, which basically gives you more leverage in the sense that you can do the same transaction with a lot less money and thereby gain a lot higher percentage return, is to write a put option with a strike price of $32.50 expiring in 1 month. So what this means is that let's see, $32.50. Yeah, you promise to sell. So you sell the put option. So the person who buys it has an option to buy the stock from you at this price, $32.50, for 1 month. So currently, this put option is worth nothing, because to the person who buys it, because if he buys it at $32.50, he can buy the stock in the market at only $30. So basically, you sell this put option at $5.50. It means that so you sell 100 of these options, so you make $550 in cash. Now, as long as the price it's the reverse. With the put option, you have the option to buy at 32.50. Yeah. The person who writes the option is eligible to buy this stock at 32.50. If he buys it, yani currently it's worth nothing. If the stock, currently it is worth something. If the price rises, it becomes worthless. Yeah. Yeah. Right, okay. Yeah. So the put option is now I've figured out. There are so many different options there. So basically, I sell you the put option. That means that I am prepared to sell the stock to you at 32.50. Is that correct? So currently, you don't want to exercise it. No, it's the other way around. Alright, I'll let you figure it out. Basically, it's an option to buy the stock at 32.50. This option is worthless if the price rises to $40 because I guess it's an option to sell. I guess that's what it must be. That I am permitted to sell this stock to you at $32.50. Yes, that's what it is. So I am allowed to sell the stock to you at $32.50. You promise to buy it from me at $32.50 throughout the next month whenever I want to sell this stock. So currently this is worth nothing because I don't want to. Well, currently it is worth something. Currently it is worth $2.50 per unit. So 250. So if I sell it to you at $5.50, then I will not exercise this option because you paid $5.50 for it and you will only gain $250. But if the price rises sufficiently, then it becomes worth exercising. Alright, so I'm going to give up on trying to understand it. You can read about it, it's easy, it's explained in Wikipedia, etc. So basically, there are many complicated deals, these are called. This is one of the most simple derivatives, and there are more complex derivatives, and they basically allow you to make very complex gambles on stocks, including that, okay, this one will rise and that one will go down, and buy this much, and so on. So, now the problem, okay, so what we wanted to show here was that Nobel Prize winners and economists tried to actually use these theoretical strategies to do arbitrage, and they could not succeed. They caused the collapse of the firm and the stock market. And so the empirical evidence shows that you cannot arbitrage, you cannot drive the price of the stock to the fundamental value. Now, why is this? There is a lot of theory which has been developed to show that why the prices will not go to fundamental value. Now, this is basically theory which counters the conventional dominant theory which is still being taught all over the world, and we are still using Arch-Gauch models to calculate the risk and volatility, even though these things have been disproven by the empirical evidence. So now this section of the paper of Barberis and Thaler explains why arbitrage might not work as expected in theory. So one of these is that there is a fundamental risk. So that is that, okay, currently you think that the stock is undervalued, and so you bet heavily that the stock price will rise, but suppose that there is some surprising event which happens, like Ford is undervalued and you bet on it's going up, but there is a news that Ford has made a defective car by accident, and now it has to issue a recall and suffer millions of dollars of loss. So now all of your bet is wasted. Then there is the noise trader risk. Okay, the stock is undervalued, but why did it become undervalued in the first place? Well, there were some people who were betting that the stock will go down. Why were they betting that the stock will go down? This is what basically Keynes said, that if there is a rumor circulating that stock is going down and people are believing, then it doesn't matter what is happening, because you're not betting on the genuine value, you're betting on what people believe about this. So as long as you think that people believe that the stock is going to go down, you're going to it's going to go down, and so you can bet on that and you can make a profit by betting on that. So this can go down even further. So now one of the points that is made in the Barberis Thaler is that frequently the managers of portfolios are trading using someone else's money. They're like in a mutual fund. So suppose that they have made a bet that the stock will go back up to its fundamental value, but noisy speculative traders make it go down even more. After all, if they could make it go down from its fundamental value a little bit, they can make it go down a little bit more. Now, as soon as this happens, the owners of the money, they might get nervous. They might say that, look, you're betting on this stock to go up, but you've already proven wrong, and your bet has lost us so much money, and now we would just want to limit the losses. So sell and get out and accept this loss rather than face even further losses. So now the fund manager will say, no, look, this is a good bet in the long run, and we are going to make money, just hold on, and they might not let you. So that's called forced liquidation, that you might not get the time to wait, because you only know that the theory says that in the long run, but it doesn't tell you how long you have to wait. Is it 1 year? Is it 10 years? So meanwhile, you're not the owner of the capital, so people might force you to liquidate. Then all the so-called arbitrage pressure will be removed. Yeah, and that's also what is called horizon risk, that somebody has said that the market can stay irrational for a lot longer than you can stay liquid. So you might end up, you keep betting against the market, and eventually all your capital is gone, and market still remains irrational. Then what will happen? You basically lose. So in addition, when you try to implement a risk, a strategy which will gain from mispricing, there are lots of transaction costs. Economic theory assumes that there are zero transaction costs, but you have to pay commission on buying stocks. There are, when you sell short of some, then there are many fees, and then there are legal restraints on selling short. I think that in Pakistan it's not allowed for the moment, and Islamically short sales are not allowed. Then there's volume constraints. There's only a certain amount of stock available, so you can't sell huge amounts. And then there is the identification cost. Suppose that some stock is mispriced. How do you know? How can you learn? So can you really? The fundamental value. This is in my view the most important point. The fundamental value is fundamentally unknown. You don't know the stock of what the stream of dividends is. So basically, fundamental value is a mystery. So how can you ever learn if something is mispriced or not? You can just make guesses about mispricing. So the textbook arbitrage, which says that automatically stocks will be driven to fundamental values. In the real world, this is not true for a large number of reasons. And there is a lot of theory which shows that, and you suppose that a stock has started to go down, and you know that the stock is mispriced and it has wrongly go down, but there are many situations in which it will be profitable for you to play along and say, okay, it will go down further, and just bet on it to go down and get out quickly before it bounces back. So you can set up a situation where, suppose the stock price goes up just by random fluctuations a little bit. So now the insiders say that, so this has gone up, people are now looking at this stock, and they buy more instead of correcting the mispricing in order to make it even more attractive, because they know that if they start this trend, so if it goes up 1% in one period, and they make it go up by another percent in the next period, then the people who are watching trends, they will say, this stock has been going up 2 periods, and so they'll buy in even more and it will go up 3%, at which point they can sell and get out. So it's you can't bet on correction of mispricing. So a lot of different types of evidence has been collected in the Barberis and Thaler survey, which proves that the theory that the stocks are priced rationally is wrong. One of these is a neat study of this company, which is Royal Dutch and Shell Transport. This is really just one company, but 40% of the earnings and shares of the stock are sold in the name of Royal Dutch, and 60% are in this name of Shell Transport. So whatever the fundamental value, it has to be exactly the same for those two. But the stocks are not selling at the same price, and they have remained at different prices for a long time. Nobody has been able to arbitrage and correct the supposed mispricing. So if the fundamental value was true, then these two stocks should have sold for exactly the same price, but they don't. So this immediately proves there's something wrong with fundamental value theory. There is some more evidence that is cited about how fundamental value does not determine the price of the stock. And so one of these is that the Standard & Poor index is just supposed to measure, it takes 500 representative stocks as a measure of the entire stock market. It is not, it does not, when the S&P includes a stock, this does not provide any guarantee as to the companies being more stable or more worthy or higher quality. Actually, they are trying to pick the average company, so it should be representative. So it should not be more risky or less risky or in any way different from any other company in the stock market in any systematic way. But it always happens that when they keep changing the index, because every once in a while one of these companies will go bankrupt, or two companies will merge and become one. So when that happens, then the 500 stocks become less, and so they pick some new company to put in its place. And whenever that happens, the value of the stock of that company jumps. Now obviously, putting a company into the Standard & Poor does not change the stream of earnings, but so this price jump is not justified according to the fundamental value theory. So if somebody was to say, okay, this is a temporary deviation and he would want to correct for this mispricing, he would fail to do so because some of these changes are permanent. So the fundamental value hasn't changed, but the price has changed, and the price has changed permanently. So there are two different values. Again, this is not consistent with the theory that the price of stock is determined by the fundamental value. So basically, this again supports the Keynesian idea that the value of stock is not determined by fundamental values. It's determined by our mutual agreement. We think that the value of this stock is this, and as long as we agree, that's what the price is. And if there's some disagreement, that will also show in the prices. It doesn't have anything to do with fundamental values. It depends on consensus opinion. And consensus opinion says that if a stock is included in S&P, then the stock becomes more valuable. As long as we all agree to this convention, so that's what the pricing is going to be, and that's the rational price. And anybody who bets against that is going against consensus, is going to lose. This is very different from the fundamental value theory. This is the beauty contest theory, that the value of the stock is whatever we believe it is. So Yahoo stock is given as an example, that Yahoo stock was 115 prior to its inclusion in Standard & Poor and became 210 a month later. So now somebody who believes in fundamental values should say that, okay, this is going to go back to 115, but it never did. So alright, so the theory of limited arbitrage shows that if irrational traders cause deviations from fundamental value, rational traders will be powerless to do anything about it. So we have to take into account irrational trading. Now this is actually written because the dominant theory is that stocks are fundamental value. Otherwise, actually to say that somebody who believes in fundamental values is rational is the opposite of the truth. One could say that if there are some idiots who believe that stocks are valued at fundamental values, then they will set up a long-term hedge management company and they will drive it to bankruptcy because their theory is wrong. So It is the rational traders who understand that fundamental doesn't work and they should develop some other rules. So now the question is, what are these other rules? So given that we have rejected the fundamental value theory, we ask to understand how stock prices behave based on how people perceive the value of the stock as opposed to the fundamental value. So now we are coming closer to actual behavior. So there are some specific heuristics and biases people have learned about how people behave by studying actual behavior as opposed to the behavior of ideal, rational investor who has perfect information about the future, which doesn't exist. So one of these things is, well, there is a list of heuristic biases. People have overconfidence. If an event is the chance of an event is 80%, they think it's certain. If it's 20%, they think it's 0. So they frequently make mistakes because of this overconfidence. They are optimists, and there are these various kinds of biases, all of which play a role in determining the value of stocks. Now, economists believe that in the stock market, if you get experience, then you will learn that these biases are wrong and you will correct them so that eventually the theory of rational trade will be right theory in equilibrium. And also that experts who have a lot of experience will not make these mistakes. And also that, especially because these things are shown in experimental settings, they said, well, experimental, the incentives are small, but if you're playing in the real world with large sums of money at stake, then you will not make such mistakes. So these are the 3 standard objections to the findings of experimental economists. However, people have tested for these effects and they have found that these are not true. People are taught the theory, it's explained to them and they understand it, but still, when you put them in the experiment, they don't behave according to this. So you can teach people that, look, what you're doing is wrong and this is irrational and so on and so forth. And they will understand and they will explain, but when you put them in the real game, they will again behave irrationally. And we will study this and we will explain why this happens. Because basically, the theory of rational behavior assumes not only that the person is rational, but it assumes that the other person is also rational. So for example, in the ultimatum game, I can explain, look, you should offer only $1 to the other person because if you offer, you will get $9, and of course he will accept it. He cannot reject it because if he rejects it, he will get 0. So for him, the outcome is 1. So you can explain this to him. But the person, if he tries this, he will fail because the other person is not, quote unquote, economist rational. So real rationality and economist rationality is not the same thing. And most people understand how real people behave as opposed to being deceived by the economists' wrong theories. So economists are very puzzled when, why did you reject? I mean, you were going to make $1. But real human beings, when playing with real human beings, understand that real human behavior is not, quote unquote, rational. So actually, in my own paper on empirical evidence, I have shown that this economic theory is actually a blindfold in front of the eyes of the economist. So those people who go in with this theory, they can't understand simple facts of human behavior which ordinary people can easily understand. So for them, for the economists, it's a big puzzle as to why people offer 50-50 splits in the ultimatum game when they should be offering 90-10. For other people, it's a mystery why economists have a problem with this. Why economists don't understand this simple natural fact of human behavior. So, learning doesn't occur. Experts often do worse than learners because they have learned the wrong lessons. There are many examples which show that experience makes you worse, and instead of converging to the optimal strategy, you diverge away from it. You start playing some heuristic rules which are actually not good. There are many ways to set it up. I mean, that show that you can get positive reinforcement from playing the wrong rule, and you can come to believe that the wrong rule is the right rule, because there is not enough variation in the world to give you the sufficient experience. And increasing incentives doesn't help. So there is this set of experiments which Daniel Pink has described, where if you offer more money to people, it just makes them more nervous and they make more mistakes in trying to achieve the correct optimal decision. So contrary to the economist's belief that if you offer more money, people will learn to act correctly, exactly the opposite effect holds in real life. People can solve more puzzles when they are doing it as a game, and less when they are offered large sums of money for the solving of the same puzzle. So we come to the second part. So basically the first part shows that the rational markets theory of Fama in French fails. And so now the question is, what is the right theory? So prospect theory has been devised as an alternative to the expected utility theory. So this expected theory was invented by von Neumann and Morgenstern in 1944, and basically they derived it from axiomatic basis. They said if people behave rationally, then they can be modeled as if they have utility functions and they maximize expected utility. So basically the axioms go as follows. You have a set of outcomes, you have probability distributions, and so they assume that there are some preferences over lotteries which satisfy certain axioms, and this is true, then these are rationality assumptions. If these assumptions hold, then people have people act according to the expected utility theory. But experimental work shows that people don't behave according to expected utility theory. Now, when the first discovered that, it was said that okay, people can make random mistakes, and that might still be okay if people randomly make mistakes, but if they all make the same type of mistake, then there is a problem with expected utility theory, that it won't even be true on the average. And that is what has been discovered. There are systematic errors, they are not random errors. So people systematically behave in ways that are different from what expected utility tells you. And there are a number of things that we observe in the stock market, like the difference between the Royal Shell and the Dutch, which is the identical stocks trades for different prices. To understand this, you need concepts from behavioral economics. You cannot understand it using expected utility theory. So a number of non-expected utility theories have come up, among which the prospect theory is the most promising. It provides a good match to expected behavior. in uncertainty. So that's what we are going to try to explain. So the original version just looks at gambles with two outcomes, two non-zero outcomes, and there is a third outcome which is zero. So the prospect theory is the prospect is x comma p and y comma q. This means that you will get the outcome x with probability p and y with probability q. Now, x is a negative outcome, and so it is a loss. Y is a positive outcome, it is a gain, and p and q are probabilities. They don't necessarily sum to 1. So if there is if there is less than 1, then you get the zero outcome with the remaining probability. So under the expected utility theory, the value of this prospect is p times the utility of w plus x plus q times the utility of w plus y, where w is your current wealth level. So now so basically, you evaluate the final outcome, where you will be after this, after you take this. So your wealth will be wealth plus x, which will be less than your current wealth, or your wealth will be w plus y, which will be more than your current wealth. And you evaluate these two according to their probabilities, and you add. This is what the von Neumann Morgenstern expected utility theory tells you that rational behavior should be. Now, under prospect theory, what people do actually is that they replace the actual probability by a function, which is the pi of p. So the probabilities are adjusted. Small probabilities may be adjusted down to 0. Large probabilities may be adjusted up to 1. Middle probabilities may all be set equal. So if its probability is between 25% and 75%, they all are treated as same. It's a good chance of getting the thing. So things like that. So instead of actually calculating the exact expected value, the probabilities are adjusted. The other thing which is very interesting is that people look at the change. They don't look at the outcome x and y. They don't look at the w plus x, which is your net gain. They isolate the decision. They say, okay, either I will gain x or I will lose y. They don't look at what will be the result of this to the total wealth. So this has been led to a literature which is called mental accounting. So according to economic theory, we look at all of our gains and we pool them into a common pool, which would make sense, and then we look at all the losses and we aggregate them. So there's only one number for our wealth. But the mental accounting theory says, no, we keep separate accounts. So for example, if somebody, there's an example given of a couple who won a lottery in which they got $500. So they both went out to a restaurant and they spent it on a very expensive luxury meal which they had never had before and they never plan to have again. Now, according to economic theory, this doesn't make any sense, because what happens is that you take this $500, you add it to your income, and now you have income. And now, from this income, if you want to go to the restaurant, you will go to the restaurant. But since they have never done that before and they have had this much money, so it doesn't make sense for them to go to this restaurant. But mental accounting says, okay, this $500 is not treated as part of regular income, so you can
spend it in a different way. So this mental accounting is very different from what economic theory says. In economic theory, we are aggregating all our lifetime income into one bundle and then we are spending it. But no, mental accounting says this year's income is this year's income, and next year maybe I'll get less. And so what the standard theory says is that if you anticipate that your income will be less, you will save money and you will spend it on next year. But that doesn't actually happen to the extent that theory predicts. So basically, you look at the value of the x and y instead of w plus x and w plus y, which is contrary to theory. Then the other thing is that the losses and gains are valued differently. So the losses hurt a lot more than the gains bring benefits. So people display what is called loss aversion. So they try their hardest not to lose anything. And then this leads to the interesting effect that if people gamble and they lose and they think that we are behind what our reference point should be, then they will take crazy risks to try to get back up. So they will display extremely risk-loving behavior because they don't want to end up with a loss. Whereas if they are up, they will be risk-averse. They don't want to invest too much in winning because winning doesn't... So if you have a win and a loss, then they are much more averse to losses than they are to winning, to gains. So in an equal plus 100 minus 100 gamble, they will never take it because the gain of 100 is not worth as much as a loss of 100 hurt. So these are the two elements of prospect theory. One is that the gains and losses are calculated in isolation and they are measured differently, and then the probabilities are also adjusted. And then you calculate this function and then you act according to this. So these are some examples of the prospect theory, that if you are given a choice between 2500 with probability 33% and 2400 with 66% and 0 with 1%, and the other prospect is 2400 with certainty, then most people take 2400. Now, in the second problem, if you are given 2500 with 33% and 0 probability 67%, and D is 2400 with 34% and 0 with 66%, then everybody chooses, or most people choose C. So now these two are not compatible with each other, as we showed last time, because if you subtract a common factor from both of them, then these two are identical gambles. But people don't evaluate them in the same way. So prospect theory offers a solution for this, but there is another solution which is separate from that. And the separate solution says that, and this is another heuristic, that people focus on only one thing. So when choosing between A and B, they say, oh, B gives me 100% shot at winning some large amount. C is variable and with 67 probabilities, it can give you a little more and it can give you less. But anyway, it's a complicated thing. So I don't bother to evaluate. I take a bird in hand is worth two in the bush. So you apply this principle because this gamble is, you have certainty, so you just focus on, okay, I can get 2400, there's a little bit of chance of getting a little bit more, that's not worth it for the extra risk. You don't really look at those numbers, 33% and 1%, very carefully to decide what to do. In the second problem, both are gambles. So now you say, okay, the probabilities are roughly the same, and now the C offers me more money. So you focus on that and you say, okay, I go for C. Now this is very, very different from the so-called rational behavior. You're not making the calculations, you're just using rules of thumb. Prospect theory is not rule of thumb. Prospect theory is still calculation based. So we've discussed this calculation earlier. So I won't go through again. Similar calculation. This shows the difference between positive and negative prospects, and basically this is called the reflection effect in behavioral theory. That if you take a positive gamble and you take the negative, then the preference also changes. So if you are offered $4,000 with 80% probability and $3,000 with certainty, most people choose $3,000, 80% of the people. But if you reverse this, if you say that, okay, we'll give you a loss of $3,000 or a loss of $4,000 with 80%, so people now choose the $4,000 loss. So it's the opposite choice is chosen, as opposed to what expected utility theory says, that people should be choosing in the same way. So there are many of these experiments. So to summarize, utility is defined over gains and losses rather than over final wealth positions. There's an issue which is called framing. So this shows the loss aversion. So in addition to whatever you own, you have been given $1,000. So people are given $1,000 with certainty, and then they are asked, choose between $1,000 with an additional 1,000, so you will get 2,000 with 50%, or 500 with 100%. So people take the B choice, having $1,000 and then 500 more, rather than taking a 50% chance of getting $2,000. Now, in the second gamble, they say, okay, we give you $2,000 to start with. Now, choose between losing $1,000 with 50% probability and losing $500 with 100% probability. Now, according to utility theory, these two are exactly the same. So people should make exactly the same decisions. But in reality, people choose B in the first choice and people choose C. Now they say, I have $2,000 in my hand. I don't want to lose $500 with certainty. I will take a chance and hope that I don't lose anything. That's the preferable. And then, okay, if I lose $1,000, yeah. So now this is called the framing effect. That how the problem is framed has an effect on how people behave, because basically in the first one, your current wealth, which you start with the calculations, is W plus 1,000, and then you look at gains from there, and you behave according to the gains picture. And in the other one, your current wealth becomes W plus 2,000, and then you look at losses from there. So these two are different. So this is the difference between win and loss. And the second important feature of prospect theory is that
Okay, that's in the probability weighting function. So there are many pieces of evidence which suggest that people overweight small probabilities. So one of these is that people are offered a choice of winning $5,000 with probability 1 in 1,000, which has expectation exactly $5, or they offered $5 with certainty. So everybody takes $5. But if you reverse this, the reflection effect, that if you're offered that, okay, you will lose $5 with certainty, or you will lose $5,000 with 1 in 1,000 probability, then people immediately go for the $5 loss. And so the intuition basically is that the by doing actual experiments on real behavior, people find that there are and people don't calculate with probabilities as expected utility shows. So basically, prospect theory has two phases. One is the editing phase, in which people set the frame of the problem. What is my initial wealth, and where is the gain and where is the loss? And this can be changed by how you state the problem. So the experiment in which some people are given mugs and asked to sell them, and some people are not given and asked to buy them. Technically, the two problems are the same for both, but people behave very differently because of the endowment effect. So you have to edit the problem to understand how people are viewing this. And then in the second phase, after the framing is done correctly, then you evaluate the probabilities and you evaluate the value of gains and value of losses, and then you come up with the evaluation, and you make decisions according to that. So one of the simple measures is that this is a numerical calculation. So the value of a prospect is x to the a, where a is less than 1. This is a convex function, and then it's minus lambda minus x to the a if x is greater than 0. So lambda is generally bigger than 1, which makes the function steep. So basically, using experiments, the Tversky and Kahneman found that a is around 0.88. That's a coefficient of sensitivity to gains and losses. That shows how convex your loss function is. And then the lambda measures the differential between there is the loss aversion. So the same thing which is when it's positive is evaluated as $1. When the loss is minus 1, then it gets multiplied by a factor of 2 around. And so studies show that this lambda is around 2. So basically $100 win, the gain from that is the $100 loss is comparable to a $200 win, roughly speaking. So if you are given a chance to win $200, and that will offset roughly the loss from $100. So that's because of the loss aversion. This is the probability weighting function that emerges empirically. There is a different values of delta for different people. So some people flatten the probabilities a lot. So a lot of different probabilities are
treated as being roughly equal, and if delta is not so large, then if delta is close to 1, then you have exactly the right probabilities. So the higher the delta, the closer to 1, the more your judgment is close to the actual probabilities, and the lower it is, the more flattening you do, with middle numbers being all treated as the same, and then sudden jumps near 0 and 1. Alright, so all of this theory, the expected utility theory, is based on situations where all the probabilities are known. Now there is an extension of this theory to the case where the probabilities are unknown. And this is basically Savage developed subjective expected utility theory. And again, this works from the same idea that given gambles between if you have to make choice over lotteries, and if you make them rationally, transitively, etc., then you must act according to some subjective prior probabilities. And this also fails to be true in real world examples. So there is this famous Ellsberg Paradox, in which you draw a ball. There's urn 1 has 100 balls which are a mixture of red and blue, but you don't know which is which, and urn 2 contains 50 red and 50 blue. So this is called ambiguity. Now you see the fundamental argument which is used by Savage and which is widely accepted, even though it's basically wrong. What you see, you are asked, okay, I have this urn, it has 100 balls, some of them are red, some of them are black. You don't know whether they are more black or whether they are more red. In this other urn, you have red balls and black balls, and they're exactly 50 red and they're exactly 50 black. So now I give you a lottery which pays you $100 if a red ball is drawn from urn 2, which has known 50% probability, and the other one gives you $100 if a red ball is drawn from urn 1, in which you don't know what the probability is. So which one do you choose? How's that?
If you know the probability, that's far more better.
Yes. Basically, people will choose the 50% chance. Now, what you see, this is where the economists are extremely confused. What they say is that this reveals that you know that there are less than 50 red balls in the first ball. This is not true, but this is what is assumed. So now you say that, okay, my subjective probability of red is less than 50%. Why? Because you chose a lottery which reveals your preference in such a way that shows that you have less than 50. But that's not actually what you are revealing. So, but when you identify this, then we can easily construct a situation in which the reverse is true. So now, if we say, okay, we make the same bet on the blue balls. Now, in the first, then again people will choose the 100 on the blue from the second urn in which it is certain. So now, on the first place, you revealed that there are fewer than 50 blue balls, but now you're revealing that there are fewer than 50 red balls. So that there's a conflict. Now, if we were to say that, okay, that there are many ways to show. So people say that this is called ambiguity aversion, and you should be consistent. So there is ambiguity. You don't know the probability. But there are many ways to explain this, which are quite simple. Basically, you say, okay, you're a pessimist, so you evaluate the bet at the least possible value. So 0% for black and 0% for red. So it makes it very clear. But subjective utility theory doesn't allow you to do that. This is called ambiguity aversion, but this is not really the correct explanation for this. So now there are many, many applications of this. One is the equity premium puzzle, which we have seen. So why do stocks have higher stocks pay a lot more in the long run than the bonds and then the certain, but people invest a lot more in banks, and so basically the explanation seems to be that people do short narrow framing and they are loss averse. So at the end of the year they calculate whether we won and lost, and if you're in stocks then you will get too many shocks. You will say that, okay, I'm losing a lot, and the gains are not valued as heavily. So now so the strategy then, if you're going to invest in stocks, is to buy them and forget about them for 10 years. So then you will don't look at whether it's doing well or whether it's doing poorly. So if you make long-term decisions, and actually very interestingly, this is also the Islamic theory. The Islamic theory says that it is permissible to buy stocks as a share of ownership, provided that you benefit from the ownership of the firm, not from fluctuation in the stock prices. So what is called day trading in Western stock market theory is forbidden in Islam, because day trading is pure gamble, that you buy a stock hoping for its stock. Now actually Islamic trading is very strongly fundamentals oriented. You should make profits only from the dividend payoffs and actually what's happening in the business. So if you do that, then Islam actually very strongly supports the idea that the stock should be valued at fundamentals, and there should not be any gambling on that stock. But basically, this gambling on the stocks is what creates all of the fluctuation in the stock market, and the conventional theory defends all of this as by saying that this creates liquidity. So people buy stocks because they know that they can sell them, and this creates greater investments, because when people buy stocks, they are investing in companies. Now, Islam says that we don't want these fickle investors. We want people who are genuine investors. When they buy a stock company, this is because they believe in the company and they are buying ownership, and you don't transfer ownership. Of course, you might be in distress for some reason, so those emergency sales are allowed, that okay, when you have a health crisis and you have to sell things that you own. But otherwise, normally the stock owner should be just someone who is holding on to that stock and he wants to benefit from ownership. He should have evaluated the firm and its long-term prospects and so on. So that's the Islamic theory, which is very different from the capitalist theory. Alright, so there are a lot of different applications in the Barberis Thaler paper, and I'm not going to cover them because I'm going to give an assignment about this. And basically the assignment is just after you finished with this experiments